It's happening, folks. Real estate tokenization, where blockchain is opening doors from turning properties into digital tokens to making investments accessible for investors, particularly retail investors or smaller guys like us, and how it's going to be impacting the private placement and syndication world that we're very accustomed to. This is obviously a big disruptor in the industry. A lot of escrow companies, realtors, lenders, title companies probably don't want this to come to fruition, but it is a movement moving forward. This article behind me, it's got me really excited to record this quick video and add some commentary along with what I see as a real estate operator out there. And as you guys know, we own and operate well over 10,000 units, $2.1 billion. So we've got skin in the game. We're not just economists out there spewing little YouTube videos out there. And I'm going to giving you some of my input on how I think this is going to be a game changer in the industry and also the little residential properties when you guys maybe buy your next home. So starting out, blockchain is not just about cryptocurrency, Bitcoin, Ethereum, or some altcoins. What it is, it's shaking up real estate big time. And the keyword here and the technology is tokenization by using the blockchain technology to trace and assign ownership to. Check out this Forbes article. We'll put the URL in the show notes below. But McKinsey's saying that we could see a $5 trillion market by 2030. And that is T with means trillion, many billions. So that's huge. And this is where tokenization is a disruptor. It's not just about the big institutional players out there, the big REITs, the guys that we compete with on a smaller scale, and possibly taking a property worth 100 grand and breaking it up into 100 tokens, for example. So more people can get in. And it's like crowdfunding. What tokenization does is creates these smart contracts to do a lot of the heavy lifting, slashing costs and speeding up transactions and verifying those transactions. So you cut out a lot of the fraud, which happens when people are wiring money back and forth and signing and notarizing contracts. As Patrick Lencioni in his Four Dysfunctions of a Team, he always says, like, when there's lack of trust, it makes things go very slowly. But when you have a sort of zero friction tokenization blockchain transparency, the security is very high, and this can streamline transactions on a small and large scale. So what do I think about this being a multifamily syndicator and operator? One thing that drives us crazy is we pay tens of thousands of dollars on legal fees every year. And that's another group of people that may or may not like this whole trend. And these lawyers, they put together these contracts so that you can legally bring in investor capital. And it's something that the SEC obviously wants to keep the bad players out of. But the SEC also, on the other side of it, is they, as much as they're seen as a cop and slowing people down, they want to incentivize the collection of capital so that it can create new businesses in America, specifically because SEC is the governing body within the United States. If it's really hard for capital to be brought together on a venture capital deal or a business or a real estate venture, things aren't going to happen. Like, the pandas out there, the endangered species. Unless we have zoologists out there having them come together and mate, unfortunately, the species of pandas aren't going to propagate. And the same thing goes for businesses. Unless there's a collection of capital accumulating in a safe and growing to the next Fortune 500 company is going to be harder and harder to come by. And right now, this is controlled by a lot of the institutional players who obviously want to keep their position at the top of the pyramid here. But tokenization is a bit of a game changer. Now you're able to streamline transactions, doing smaller types of syndications, capital arrangements now become a lot more scalable to be doing smaller stuff. So in our world, for example, like big REITs will buy thousands of rental properties all in one little portfolio that they have amongst their library of other portfolios. They don't really like to buy little single family home rentals, which is why I still think if you're a new investor who has a low net worth under $500,000, buying little rental properties, you may still have a bit of an edge there because the big players don't want to mess with that type of stuff. It's a little bit too much of a headache. If you're a non-accredited investor, check out our remote rental e-course, which you guys can access for free by joining our club at thewealthelevator.com/club. And checking out that info page we have on buying little rental properties at thewealthelevator.com/turnkey. It's the way I got started investing back in 2009. But as I always say, when you start to get to bigger and bigger investments, you need to scale up. The point I'm trying to make here is the big institutions don't really want to mess with these smaller types of transactions. But once tokenization comes into play, it might make transactions more possible for the bigger guys to go and grab everything out there. Now, a lot of investors, they like to invest in cool things like vending machines or laundromats. To me, I think it's too much of a headache to be doing that. One of the big deterrents in that, if you have staff, they're typically stealing quarters and dollars. And with the advent of digital cards and apps and digital payments, now if you're owner of vending machines and laundromats and car wash, it's less chance of your money getting stolen by your employees. But I digress a bit. That's just one example of technology coming in and reinvigorating an old school type of business like that. And in a way, tokenization of assets and democratizing ownership of these assets in a very scalable, secure way is also a game changer here. I think the one thing that needs to be ironed out is the contracts portion of it. Sure, you can backtrace the ownership of a certain coin that's created that is 100 coins may equal this one particular house. That can be verified. But I think what we still need to get over the hump here is the SEC and then the IRS. So the first, SEC. Laws are made in place for good reason. I think the SEC does a good role in keeping bad players out. This is just going to need to get bought off by the SEC. However, there's good news, right? We've seen the adoption of ETF, depending when you're watching this video in the first quarter of 2024. So that was a huge thing. And if you've seen crypto have a little resurgence recently, that's the reason why, because now the inroads are built so the bigger institutional players are able to get the retail investors in there. And this is why we like investing in apartment buildings, because the inroads to get access to these types of assets isn't accessible by everybody and their mother out there, the retail investors. But at some point, tokenization may bring these people in. So if you're investing in off-market syndications and private placements and these country club deals, it's better to get in now. And then when the inroads are created through these smart contract tokenization methods, the flood of cash is going to go up. And more than likely, we're going to start to see a lot of inflation in prices with a lot of, I'm sorry to say it, but the dumb money starts to come in. But that's my take as somebody within the industry, pretty excited about it. Still, I think the last thing that's yet to be seen is taxes. Obviously, that IRS likes to keep track of when people are having capital gains, when they're selling assets. It's going to be really hard for them to get a handle on when those 100 investors sold that $100,000 property and had a $20,000 gain, or in this case, if they divided by 100, it was a 20-cent gain. That 20% gain for those 100 investors needs to get registered with the IRS so the IRS can take their cut. Obviously, there's not really a clear mechanism for the IRS to get theirs. Everybody to get on board with sending in their receipts and truthfully doing it, even though that's the way the tax system is currently set up, where you have to tell the truth. You have to be honest what you sold it for. But when you have the ideal blockchain is anonymous, now maybe you're starting to see a different type of behavior where a lot of these people, when they sell, they may not tell anybody nor the IRS what they made. So I don't know. As me, as a person of the United States who likes to see other people pay their taxes, it's a little bit concerning to me. I guess we just have to see how this plays out. But you heard it here first, right? I guess Forbes dropped this major article here, but just something to think about. And I think you've been seeing some of the other videos of mine where I really point out disruptions. What's cheap, right? What is it that people aren't talking about? And I just want to pose that question here. Maybe we can get a comment dialogue in the comment section below. But that's a way an investor needs to think. What is something that is just under our noses, that is somewhat hot, that most people aren't talking about? But with that, I'll drop that article link in the comment section below, and we'll see you guys next time. Bye.